tariff inflation changes portfolio risk because it is not simply higher prices. It is a policy shock that moves through supply chains, corporate margins, interest rates, and currencies at different speeds. A tariff is paid by the importer at the border, but the cost can be divided among foreign producers, domestic businesses, and consumers. The 2018 U.S. safeguard tariffs on imported washing machines showed this chain clearly. Washer prices rose, and dryer prices rose too, even though dryers were not directly tariffed because retailers commonly sold the products together, and domestic producers had room to adjust pricing. Investors therefore faced more than a customs charge. They faced shifting demand, changing margins, and potential inflation in related goods. That is why tariff risk should be treated as a transmission chain. Track who pays, when contracts reset, which substitutes exist, and where pricing power sits. That approach reveals the real economic pressure before a political headline becomes an earnings surprise. The critical distinction is between an initial price increase and a persistent inflation cycle. Tariffs lift the landed cost of targeted goods quickly, but broad inflation develops only when businesses pass costs through, workers seek higher pay, and consumers continue spending. The 2018 U.S. steel tariff provides a practical example. Domestic steel prices increased, giving some producers support, while manufacturers that use steel faced higher input bills. A machinery company could absorb the cost, raise equipment prices, reduce hiring, or combine all three responses. If customers resist higher prices, growth weakens and the inflation impulse fades. If demand remains strong, price increases can spread through contracts and wages. Portfolio risk therefore depends on persistence, not merely the published tariff rate. Watch producer prices, corporate guidance, wage growth, and inflation expectations together. They show whether a border tax remains concentrated in targeted goods or is becoming a broader cycle that can influence policy, earnings, and valuation. Tariff inflation can hurt stocks and bonds together when it puts the Federal Reserve in a difficult position. Higher prices argue for tighter policy, while weaker trade, investment, and consumer confidence argue for easier policy. During the 2019 trade conflict, the Federal Reserve cut interest rates while repeatedly pointing to global weakness and trade uncertainty. That episode showed why the policy response cannot be inferred from inflation alone. In a different environment, stronger demand and rising inflation expectations could push long-term Treasury yields higher, even as analysts reduce profit forecasts. Equity valuations would then fall under a higher discount rate, while longer maturity bonds would also lose value. A traditional stock and bond mix might provide less protection than expected. Separate duration risk, credit risk, and equity risk, rather than assuming any bond allocation is automatically defensive. Shorter maturity bonds, Treasury inflation-protected securities, and deliberate duration limits can reduce sensitivity when tariffs make both growth and inflation uncertain. Managing tariff risk starts with mapping economic exposure, not reading the country label on a fund. A company can be listed in the U.S. while depending heavily on imported components, overseas assembly, or foreign customers. Apple is a familiar example. Its shares trade in the U.S., yet its supply chain and customer base span many countries, so trade restrictions can affect production costs, product availability, currency translation, and overseas demand. A domestic software provider with minimal physical inputs has a very different exposure, even if both companies sit in the same index. Review major holdings for imported input intensity, geographic revenue, supplier concentration, and the ability to relocate production. Also look through ETFs, because an apparently broad fund can still be dominated by a small group of globally connected companies. The goal is not to predict every customs category. The goal is to find channels where one policy change could damage several holdings at once, then diversify those channels before markets reprice them. Within equities, pricing power is more valuable than simple revenue growth during a tariff shock. Companies protect shareholders when they can raise prices without losing too many customers, redesign products, or negotiate better supplier terms. In 2018, Coca-Cola discussed price increases as freight and metal costs rose, with aluminum trade policy adding pressure to packaging costs. A strong brand and broad distribution network gave the company more flexibility than a producer selling an undifferentiated product. Compare that with a heavily indebted retailer competing mainly on price. The retailer may absorb a 10% import cost increase, lose customers after raising prices, or borrow more to protect inventory. Investors should examine gross margin stability, repeat demand, inventory turnover, debt refinancing needs, and management comments on sourcing. A quality business can still decline at the wrong valuation, but resilient cash flow reduces the chance that a temporary border cost becomes permanent earnings damage. During tariff inflation, the ability to adapt is often more valuable than growth built on fragile margins. Diversification works best when it includes different economic drivers, not merely more ticker symbols. The 2018 steel tariffs illustrate why. U.S. steelmakers, such as Nucor, benefited from stronger domestic pricing, while Ford said higher steel and aluminum costs created about $1 billion of pressure on its profits. Both were large U.S. industrial companies, yet the same policy moved their economics in opposite directions. Tariffs can also hurt exporters through retaliation and reward logistics firms that help businesses redesign supply chains. Broad sector labels therefore miss important differences. Build diversification across input exposure, customer base, geography, business model, and interest rate sensitivity. Then, cap any position that relies on a specific exemption, election result, or negotiation, because policy reversals can happen faster than factories can adjust. The value of diversification is not that every asset rises during a trade dispute. It is that gains in protected or adaptable businesses can offset pressure elsewhere, preventing one tariff pathway from controlling the entire portfolio. Inflation hedges should be selected for the type of inflation the portfolio faces: Treasury inflation. Protected securities adjust principal with the consumer price index. Commodities respond to physical scarcity, and gold often reacts to real interest rates, currency confidence, and uncertainty. The 2022 inflation episode showed that these assets do not move together. Inflation remained elevated, yet rapidly rising real yields pressured longer maturity bonds, including some Treasury inflation-protected securities funds. Energy commodities performed very differently from many financial assets, while gold did not mirror each monthly inflation report. A tariff shock can create similar divergence. Consumer goods prices may rise, while weaker global manufacturing pushes industrial commodities down. That is why inflation protection should not become one oversized trade. Use a measured mix. Understand the duration and volatility of each holding, and set position limits. The objective is to reduce sensitivity to unexpected inflation across several pathways, not to assume that any asset with an inflation label will rise whenever tariffs are announced. Currency exposure can soften tariff damage or amplify it, so international diversification needs a currency plan. A stronger US dollar can reduce the domestic cost of imports, but lower the dollar value of overseas investments. In 2018, the dollar strengthened as US rates and growth diverged from several major markets, adding a currency headwind for many US investors holding unhedged foreign assets during the trade conflict. The reverse can also occur. A weaker dollar can raise import inflation while increasing the translated value of foreign earnings. A currency-hedged ETF reduces some translation risk, but hedging has costs and can remove gains when the dollar falls. Investors do not need to forecast every exchange rate. They need to know whether currency exposure is intentional and how it interacts with tariff scenarios. Combining hedged and unhedged international holdings can preserve diversification without making the portfolio depend on one currency view. Currency is not a side effect here. It is a main channel connecting trade policy to portfolio returns. The most reliable defense is a rules-based rebalancing process supported by liquidity. Tariff headlines arrive quickly, but supply chain and earnings effects unfold over months. After broad U.S. tariff announcements in April 2025, global equities fell sharply, then reversed part of the decline when implementation was paused for many trading partners. Investors who treated each headline as a permanent forecast faced a powerful temptation to sell low and buy back high. A predefined allocation band offers a better process. If a 60% equity target falls to 54%, the rule can direct a measured purchase using cash or maturing short-term bonds. If a relief rally lifts equities to 66%, the same rule can trim risk. This does not predict negotiations. It converts volatility into disciplined position changes while preserving liquidity for expenses and opportunities. Set allocation ranges, maximum position sizes, and review dates in advance. Risk management becomes more dependable when actions follow thresholds rather than the emotional intensity of the latest announcement. The strongest tariff plan is built around scenarios because the outcome is a range, not a single forecast. Test a limited tariff with quick exemptions, a broad tariff with retaliation, and a prolonged conflict that combines higher inflation with weaker growth. In 2019, tariff negotiations repeatedly shifted between escalation and temporary relief, reminding investors that a portfolio built for only one political outcome can be whipsawed. Estimate how each scenario affects earnings, yields, currencies, and liquidity, then reduce exposures that fail across several paths. The core lesson is to trace who absorbs the tariff, distinguish a price jump from persistent inflation, favor resilient cash flows, map hidden supply chain exposure, diversify economic drivers, choose inflation hedges carefully, and rebalance with rules. You do not need perfect political predictions. You need a portfolio that can survive imperfect ones. If this framework improved your risk plan, like the video, subscribe to the channel, and comment with the portfolio exposure you plan to review.